Hi everyone, welcome to Deloitte Debrief's Tax Webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled M&A and Carve-Out Strategy in Southeast Asia. My name is Daniel Ho and I am a tax partner based in Singapore. I lead our M&A tax practice in Deloitte Southeast Asia and I have the pleasure of hosting today's webcast. I have 5 very experienced speakers with me today: Kee Soo-Wen, John Lawrence, Nan Dan, Sim Kwang Gek, and Nyong Yukatong. Soo-Wen is a partner based in our Singapore office and heads our financial advisory practice for Southeast Asia. John is a tax partner and he leads our M&A tax practice in Indonesia. Nan is a tax director based in our Vietnam office. Kwang Gek is a tax partner and leads our tax and legal practice in Malaysia. And lastly, Nyon is a tax director based in our Thailand office. You may access our bios on the left-hand side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for the event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Now, next slide, please. Let me give you an overview of the topics we'll discuss today. In the next segment, I'll invite Soo-Wen to talk about M&A market trends for carve-out in Southeast Asia. And following that, we will dive deep into each country's tax implications in respect of carve-out. And after that, we have a short closing followed by Q&A. So without further ado, let us dive into the presentation proper. For the first segments of today's section, let me invite Soo-Wen to give an overview of the landscape in Southeast Asia as it relates to transactions and carve-outs. Soo-Wen, over to you.
Thanks, Daniel. Thanks everybody. Good morning, good afternoon, and good evening. I'm not sure which part of the world you are dialing in from, but welcome. The slides that you can see on screen is the M&A activities in Southeast Asia. The dotted lines are representative of the number of deal counts, and the bar is the deal value, the aggregated deal value. So you can see that the activities in Southeast Asia was fairly good, and then when COVID hits, the number of deals has reduced significantly until end of last year. Then we can see that the activity started to pick up again. And then what happens when the Russia-Ukraine crisis, basically that has affected the number of deal closure, and you can see that it has fallen off to a much smaller number, especially in April. But if you look at the bar itself, the volume, not the volume, but the value itself has increased substantially. But don't be mistaken, the value is actually driven by one big project or one big deal. That is the Grab demerger with a SPAC, or the SPAC, de-SPAC in the US. So that is a $40 billion deal. And that was in December 21. But on the overall, there was a recovery in the M&A activities in Southeast Asia after about 1 year of COVID. There's a lot of money in the system. The system is continuing to drive acquisitions, driving activities in our part of the world. And we will need to sit down and see what is the impact of the Ukraine war. So let's keep our eye closed on the activities, and we are more than happy to keep you posted as we move forward into the future. Let's move to the next slide. This is a slide where it shows the activities in the last 2 years, so 24 months. So the M&A activities in Southeast Asia is largely driven by Southeast Asia countries or companies in Southeast Asia doing acquisition in Southeast Asia. So the row at the top is the target destinations of the company. So the target company, which countries are they incorporated in, or where are their HQ? The row at the bottom are where the investors are coming from. So if you look at the last 24 months, most of the M&A activities are in Singapore, and then Indonesia, followed by Vietnam. So Vietnam is also a very hot M&A countries. And if you look at where are the investments sectors, you will see that transportation, hospitality, and service sectors dominate the M&A activities in Southeast Asia, followed by technology and then industrial products and TMT. So that's the type of activities that's happening. And then when you look at the investor, where does the investor coming from? So Singapore contributes a significant number of investments, companies or Singapore companies doing the acquisition, followed by US. So you will see Singapore, US, Japan. So outside of ASEAN, US and Japan are two bigger countries. And then if you move down the number of bars, then you will see China, Hong Kong. If you combine China, Hong Kong, then China, Hong Kong will be one of the major foreign investors coming to Southeast Asia. And where are these investors coming from? Which sector? Most of them are in financial services. Financial services will include the private equity. And then mixed industry will be those conglomerates, groups that has multiple businesses. So a good summary is that the activities, M&A activities in Southeast Asia continue to attract a lot of attentions, and key investors coming to Southeast Asia is going to be Southeast Asia ourselves, basically doing a fair bit of integration and consolidation regionally. And foreign investor outside of Southeast Asia, it will be US, Japan, China. These are the three main countries that is coming to our part of the world. Okay, move to the next slide, please. So these slides will be talking about briefly identifying what is the reason for companies doing carve-out. So we do see, because of COVID, there was a bit of a distressed environment. So the distressed environments will result in situations where company will ring fence the better business and then try to divest the better business to somebody else to realize some of the cash flow. So with cash flow, hopefully they can help to manage their current distressed environment. And in Southeast Asia, we do have a lot of companies that are into multiple businesses. The other common trends is business model transformation. In the past, there is a fair bit of focus on country. So I'm in this country, right, and I'll be in 3 or 4 or 5 different businesses. So when I refocus my business model and I look at digital transformation, and that's where I may sell some that are not so core to me anymore, and then I will take the money and reinvest into something that is closer to heart, so closer to the core competency. So this is where we see business model transformation resulting in carve-out of existing business to be sold. Regulatory geopolitical consideration is another one, where regulatory basically prevents certain industry from continuing to be held by foreigners. And that's where the considerations could be that they will exit certain business. And then if you look at ESG consideration, that is also driving a lot of divestments, especially those in ESG or environmentally less friendly assets. So because of country or focus that they say that we need to move into sustainable energy, then some of the non-sustainable energy could be on the divestment list of some of our clients. And lastly is what we call value creation. Some companies will basically build a business, and then at a certain point of time, they feel that is the right point of time to let go so that I can release additional value, or I may invite a partner to join into my business so that I can transform this business. And this is part of the carve-out strategy where you find a strategic partner to transform an existing business. Okay, with that, I will pass it back to Daniel.
Thanks, Suwan, for the very interesting insights. At this moment, maybe we will just run through a polling question. So the question is, what would be the main reason to pursue a carve-out for your business? And the options are, number one, to focus resources on the core business. Another option is due to ESG considerations, as what Suen has mentioned. Another option is to generate additional capital. Fourth option, to divest underperforming business. Fifth option, due to risk of regulatory considerations. And the last option is not applicable because you may not be considering your carve-out for now. So please please kind of select for your option, and then we'll look at the polling results. But while we are waiting for the results to come in, perhaps let me just ask Suen a question. Do you have any advice for companies that are preparing to undertake a carve-out exercise, Suen?
Yeah, thanks, Daniel. A common saying will be that if you are not well prepared, so it's better to be prepared rather than not prepared. If you are not well prepared, then you are technically preparing to fail. So the term is always failure to prepare is preparing to fail. So in a carve-out environment for businesses, especially when the business that you plan to carve out is really integrated with your broader group, then the whole exercise will involve lots of consideration. And the separations, we call it separation of two businesses. The separation exercise will result in transaction costs. And one of the key considerations in this type of separations will be tax. So it's important to understand the tax implications before you embark into a carve-out journey or separation journey. And when you are well prepared, then the whole transactions will be able to go through smoothly, especially the questions from all your investors or buyers will be asking all these questions. So back to you, Daniel, and to all the rest, hope you have a good carve-out. Daniel?
Thanks, Suen. Yeah, the results are out. Majority say it's not applicable because they're not considering a carve-out. So but I hope you find the session today useful because we are going to talk about tax implications of a carve-out. I think the other reasons vary. Divest underperforming business seems to be one of the main reasons as well. So without further ado, let's move on to dive in specifically about the tax implications. So firstly, we have presented 5 countries today, and first up is Singapore. And let's look at what are some of the tax implications or some of the options in relation to carve-out. Firstly, just wanted to highlight that there is no demerger concept in Singapore. So when we look at business divestments, we need to consider whether the target business to be divested is already contained in a separate legal entity or group. If so, then there's no need for carve-out of the assets. As you can see in this diagram, the shares of the Singapore target, Singco in this case, can be sold, or you can also sell the shares. In a share sale scenario, you may all be aware that in Singapore, we don't have the capital gains tax. There's no bright line test in terms of what constitutes capital versus revenue gains, because if the gains are characterized as revenue gains, they are taxable in Singapore at 17%, where the seller operates in Singapore. If the seller is an offshore entity and has no presence in Singapore, the gain may not be taxable as foreign source income. In relation to sale of ordinary shares, there is a safe harbor exemption, but subject to conditions, which requires the seller to have held the ordinary shares for at least 2 years, with minimum 20% ownership during the period. Then the gains on disposal can be exempt. When there's a sale of shares in Singapore entity, there will be a 0.2% stamp duty payable. However, in an indirect share sale scenario, where shares in the offshore holdco is sold, there is no Singapore stamp duty unless the Singapore target owns primarily Singapore residential real estate. And in a share sale scenario, the buyer would inherit the historical liabilities of the target, and any unabsorbed losses of the Singapore entity or target will be forfeited unless a waiver of shareholding tax is granted. And if the buyer is a Singapore parented group, headquartered in Singapore, then M&A tax allowance, certain benefits may be available in the form of additional allowances subject to conditions. Next slide. So in this case, if you're looking at a carve-out and the target business exists with other businesses in a single legal entity, then there needs to be a carve-out or reverse carve-out of that target business. And then the way you execute it will depend on the tax and legal implications and ease of execution. So a carve-out in this context would mean the target business is sold directly to the buyer entity or moved to a separate vehicle, which is then sold to the buyer group, while the retained business stays within the divesting group. So for example, in this diagram, the target business might be shifted from SingCo to BidCo of the buyer, and this is considered a carve-out. A reverse carve-out is the opposite, where the business to be retained is actually transferred to a new group entity owned by the divesting group, and thereafter the transferor entity is sold. So in a recent project, one of our clients actually carved out the China business to a separate entity to be held by the shareholders, because that business is to be retained by the shareholders. And this is to avoid dealing with transfer of multiple legal entities in US and other countries, which will trigger a lot more complex tax implications. So when there's a carve-out of the business or assets, we need to consider, we need to bear in mind some considerations. Firstly, obviously we need to look at the nature of the assets to be transferred, and whether there will be a step up in asset cost from the buyer perspective. So typically, if the business or assets are sold to a third party, there will be a step up. And from the buyer perspective, you have to consider whether capital allowances are claimable on fixed assets and whether they are considered plant and machinery. To the extent that certain IP are transferred to the buyer, then those costs may be eligible for writing down allowances, subject to anti-avoidance rules if the qualifying IP is transferred to related parties. And I earlier mentioned on stamp duty that's applicable to transfer of Singapore real estate or shares. From the seller perspective, the main issue is whether the disposal of the assets of the business would trigger a taxable gain. And generally, if it's divestment of business, a capital gain position can be supported unless the gains are attributable to revenue assets such as trading stock. Another issue is purchase price allocation, and this is important for determining whether the gains are taxable or non-taxable, and the amount of capital allowance claim or the stamp duty payable on real estate, for example. And you may need to perform a purchase price allocation to support the value of some of the assets, for example, valuation of IP. Goodwill is generally, if goodwill is paid by the buyer, that is not tax deductible or amortizable for tax purposes. And where there's transfer of a business or assets, the tax attributes would remain with the transferor in terms of unabsorbed tax losses or capital allowances, so that cannot be transferred to the buyer. Next slide. So I'll just hand over this segment to Kwang Gek to take us through the Malaysian tax implications of carve-out options. Kwang Gek.
Thank you, Daniel. All right, so for Malaysia, the divestment or carve-out structure are pretty much similar to those discussed by Daniel for Singapore. So I will discuss the Malaysian tax considerations relating to disposal of shares and carve-out of business or assets. So let's start with a share divestment scenario here. So here it's showing a disposal of shares of HoldCo or shares of MYCo, Malaysia Co. Yeah. So in Malaysia, when it comes to carrying forward of unutilized tax losses or capital allowance in a company, there are some restrictions under two conditions here. If there is a substantial change in the shareholding of the company, which is more than 50%, and they look at direct shareholding. And number two, if the company is dormant. So both conditions, yeah. So in this example here, the unutilized tax losses as well as capital allowances can continue to be carried forward as long as the Malaysian company is not dormant at the time the share transfer takes place. Now, one very important consideration when it comes to buying companies with tax losses is to ensure that the transaction is not a tax-driven one, but undertaken with commercial considerations in mind. Otherwise, the tax authorities in Malaysia, they have the power to invoke the general anti-avoidance provision and disregard the tax losses totally. Yeah. So also please take note that there is now a 10-year limit on the carrying forward of tax losses. Okay, from a stamp duty perspective, the transfer of shares of a private limited company in Malaysia, which is called a Sendirian Berhad, is subject to stamp duty at 0.3% on the value of the shares. Now, valuation of shares is based on the higher of the net tangible asset or the consideration for the shares, whichever is higher. If the acquisition here is at holdco level, and if holdco is a non-Malaysian company, then Malaysian stamp duty will not apply. In terms of real property gains tax, RPGT for short, it really depends on whether the Malaysian companies are regarded as a real property company, RPC. So disposal of RPC shares is subject to RPGT, and the RPGT rates ranges from 30% to 5% depending on the holding period of the shares and the profile of the disposal. Just briefly, a real property company is a company that owns real property or RPC shares of which the market value is at least 75% of the value of the total tangible assets of the company at the time of the acquisition. Now, what about the buyer? For the buyer, if you buy RPC shares, then there is an obligation to retain an amount from the consideration payable to the seller. The retention sum here is the entire amount of the consideration in money, or 3 or 7% of the total consideration, whichever is lower. For the buyer, it is required to remit the amount retained to the Malaysian tax authorities. If you do not do that, then there is a 10% penalty on the amount that should have been withheld by the buyer. Next slide, please. Okay, this table shows you the rates of RPGT depending on the profile of the seller and the period of ownership of the shares. Yeah. So if the seller here is a company not incorporated in Malaysia or a non-citizen, then you will see that the RPGT rates are higher for disposals made within 3 to 5 years. Okay, next slide. Right, here you have is a asset, carving out asset scenario where you have the buyer acquiring the business from MYCO. Now, from an income tax perspective, the tax treatment on the transfer of tax depreciable fixed assets would depend on the relationship between the buyer and the seller. So if it's a third-party transfer, then the difference between the sale proceeds and the tax written down value would be taxable or allowable on the seller, depending whether it is a balancing charge or a balancing allowance arising from the disposal. Now, for the buyer, then you get to claim initial allowance and annual allowance based on the tax written down value of the assets acquired. So here, a purchase price allocation is important. If it's a controlled transfer, then it would be tax neutral for the seller. Buyer claims annual allowance based on the tax written down value of the assets acquired. Sorry, just now let me make myself a little bit clearer. For a third-party transfer, the buyer claims initial allowance and annual allowance based on the value of the assets acquired. Yeah, not based on the tax written down value. Tax written down value would be relevant in when it comes to a controlled transfer. Okay, now it comes to transfer of stocks here. For transfer of stocks, the value of stocks transferred would be deemed as value of the stocks for the buyer, even when it comes under a related party transactions, under two situations. If the seller has permanently ceased business and if the buyer continue to use the stocks in its business. So if the transfer value is much higher than the market value, it doesn't really matter. As long as you satisfy the two criteria that I mentioned just now, the value can be taken as the value of the stocks for the buyer. Now, when it comes to transfer of receivables, it will not be deductible for the buyer if the debt turns bad in the future, right? So it's very important for the buyer to assess the recoverability of the receivables before acquiring them. Next slide, please. Okay, when it comes to unutilized tax losses or capital allowance, these amounts cannot be transferred to the buyer, and so it will remain in MYCO. For stamp duty, then the transfer of property will be subject to ad valorem stamp duty, which is 1% to 4%. Now, the meaning of property under the Stamp Act is very wide. It includes land and building, contracts, receivables, as well as goodwill. In terms of RPGT, then this will be applicable when it comes to disposal of real property or RPC shares. So meaning of RPC here, I've shared with you just now the definition of an RPC. Now, when it comes to the meaning of real property here, it can be very wide as well. It includes land, building, as well as any other rights over a property. So, for example, long-term leasehold land and building. The RPGT rates as well as the buyer-seller obligations are same as those discussed under the share acquisition scenario just now. From an indirect tax perspective, then, if all these assets have obtained sales tax or import duty exemptions when they were first acquired, then the disposal of these assets would require approval from the customs authorities. Okay, then this wraps up the Malaysian tax considerations. I will now hand over to John to discuss the Indonesian perspectives. Over to you, John.
Thank you, Kuan Greg. Next slide. For Indonesia, these are the typical carve-out approach that we've seen in the market, which I think majority are quite similar as what discussed for Singapore and Malaysia. So share deal is where, of course, you can dispose shares of the Indonesian company directly, or alternatively exit at the offshore parent entity, or what we call as the indirect transfer or sale. Business or asset deal, you can dispose a portion of the business or unit, while the reverse carve-out is the opposite, of course, where the vendor basically transfer the out-of-scope business or asset, or the retained business or asset to a newly formed entity, and then later on sell the existing entity to the buyer. The last one is spin-off, which I think in principle it's quite similar to a business and asset deal. But of course, this is typically discussed separately in the context of internal restructuring. And there are some tax incentive or benefits that can be enjoyed if certain facilities or conditions actually can be fulfilled. Now, if we move on to the next slide, for the share deal, the exit by transferring or selling shares of an Indonesian entity or direct sale, and basically that would trigger tax at the rate of 5%, income tax basically. Whereas if the Indonesian company is a listed entity in the Indonesian Stock Exchange, then the rate would be 0.1%. Both these rates actually applies on the transaction value or the gross proceed. There might be relief depending on the jurisdiction of the seller here. But of course, as you probably heard, in Indonesia, there are a couple of substance or administrative requirements that need to be fulfilled by the seller if the seller wishes to utilize the treaty protection. In the case of indirect sale, which is in this case parent entity selling shares of holdco entity offshore, there is as well a transfer tax at the rate of 5%, but this tax is only applicable if the offshore company, which in this case Holdco, is located in the tax haven country. If this transfer tax applies, meaning the Holdco is indeed located in the tax haven country, there is also a possibility to seek relief from the based on the applicable tax treaty between the jurisdiction of parent and Indonesia. From a buyer perspective, due diligence is definitely needed to assess the historical tax exposure of the target for both valuation as well as the negotiation purpose. And then basically the buyer will also like to ensure that the buyer's entity, the one that is going to acquire Indoco later on, will be able to satisfy the Indonesia substance condition in order to access the treaty in the future repatriation. On the next slide, discuss about the asset or business deal. So principally, if the transfer of non-property asset, the gain arising from this transfer will be subject to the ordinary tax regime, meaning the gain after, of course, if there's any losses, then the remaining taxable income will be subject to corporate income tax at the rate of 22%. If the asset being transferred is actually property, there will be a specific tax regime applicable to such disposal, which is 2.5% on the value of the property. In this deal, of course, the buyer can enjoy a step up in the basis for tax depreciation, including, of course, amortization of goodwill. For the acquisition of property by the buyer, there will be acquisition duty of around 5% on the transaction value or the deemed value as assessed by the regional authority. So if you compare this with the share deal, obviously this offers an advantage because, of course, the buyer will not inherit any historical tax risks of the seller, basically. However, of course, there are also non-tax considerations, of course, that the client will need to consider, such as licensing and additional efforts, for example, required to have the buyer company up and running in Indonesia. Lastly, from the indirect tax perspective, the Indoco will need to collect VAT, and the rate now is already 11% on the transfer of asset. If the VAT is paid, basically, the buyer principally can claim credit on the assumption that the business of the buyer entity is also subject to VAT. If you're talking about business transfer, actually, there is actually sort of like a relief in the latest VAT law, which talk about business acquisition. But be very careful because I think up until now, there is no clarification or definition or including the condition for this VAT relief. Now, on the next slide, as I mentioned, this is basically the reverse or the opposite of the business or asset deal. So in here, basically, the vendor will need to first transfer out the out of scope or retained business or asset to a new entity, and then later dispose share of the existing entity. Of course, this approach is typically implemented if the value of the target business or asset to be sold is material, which, of course, because it's material, it can also trigger material taxes if transferred. Therefore, it is very effective if the target business or asset is higher than out of scope or retained business or asset. The big assumption here, of course, that on the subsequent sale of shares of the Indoco 1, basically there will be a treaty relief because otherwise the 5% tax that I discussed in the share deal will also be applicable. On the transfer of the business or asset, the implication is relatively similar to the business, direct business or asset deal. Now, on the last slide for Indonesia, next one, we talk about spin-off. As I mentioned, this is principally a business asset transfer, as discussed before, but it is done for the purpose of internal restructuring in order to enjoy the textbook value spin-off facility. So this facility, principally, it can be obtained from the tax authority, then the transfer can be done at the book value, meaning, of course, there will be no gain No gain meaning then there will be no tax need to be paid on the transfer. But this facility can only be available in certain situations here. As number one is if within 2 years that there will be IPO, basically after the receiving entity received the asset, there will be a spin-off of Sharia business unit, which is of course this is part of the requirement from the central bank or FSI authority in Indonesia for separation between banking and Sharia business. The third one, if of course the Indoco 2 actually will be receiving foreign capital injection for a minimum amount of 500 billion rupiah. And the last one, which is I think only relevant if you're for the government, if for the purpose of the structuring of the state-owned enterprise in order to establish the holding company for specific based on industry. Now, if, as I mentioned, aside from the income tax, there will also be indirect tax facility if for this spin-off basically. Then basically, so long as both the transferor and the transferee are registered for VAT, there may be potential VAT exemption based on the current VAT law. With that, Daniel, I'll give it back to you. Thank you.
Thanks, Pak John. We have come to the second polling question of the day. The question is, if you have previously attempted to pursue a carve-out of your business but was unsuccessful, what was the main reason? You have 5 options. The first option is the business was retained due to a change in business strategy. The second option is unable to find a buyer. Third option, unable to agree valuation of the buyer. Fourth option, too complex due to tax, legal, regulatory, and accounting considerations. And last option is not applicable because you have not pursued carve-out before. And while we're waiting for the polling results, perhaps let me just ask Pak John a question. Earlier, you mentioned that a spin-off approach in Indonesia should not give rise to tax exposure, but this requires approval from the authorities. So can you briefly describe what are the conditions to apply for the tax-neutral spin-off?
Yeah, good question. So there are several conditions, obviously. Firstly, because this is pre-approval, that means that an application will need to be submitted to the tax authority. And there's a timeline of 6 months from the time of the spin-off occurred, actually. The applicant should not have any outstanding tax liability. And there will be some process whereby they can seek sort of like the clearance letter from the tax office. And then the applicant should commit that they will fulfill certain business purpose condition. And this condition could include, number one, that they should not transfer the asset received actually within 2 years. And then secondly, they should continue the business received from the transferor for at least another 5 years.
Thanks, Pak. So it does mean that there are certain lock-in requirements for the spin-off to work. And we have the polling results. And I think, again, the majority says they have not pursued carve-out before. But there's quite a sizable portion that says it's because it's too complex. And perhaps that's because of the need to actually carve out the target business, because it may not sit nicely within a single legal entity, and therefore all the complications around what Pak John has mentioned around licenses, around taxes will arise. Okay, let's move on. Next segment, I think I'll ask Nyon to take us through the Thai tax implications of the carve-out. Nyon?
Thank you, Daniel. Yeah, thank you. For Thailand, common approach for carve-out is not too dissimilar to what you have already heard from other. Basically include share deal, asset deal, as well as amalgamation, which may be used depending on how the deal is going to be structured for the benefit of the parties involved. Share deal is straightforward approach, but the buyer needs to bear in mind that there could always be historical tax exposure consideration of the target. For the business or asset transfer, generally is taxable transaction. However, there are tax incentive schemes granted by the Thai Revenue Department to encourage the business carve-out, which are partial business transfer, also known as the PBT, and the entire business transfer, so-called the EBT. Both schemes having different tax incentive and conditions, which will be discussed later. The last one is amalgamation, the scheme under the Thai Civil and Commercial Code. Amalgamation is a consolidation of two or more companies into one entity. The amalgamated companies will be dissolved by law, and the newly established company will be entitled to all rights and obligations of the amalgamated companies. When talking about the carve-out, we sometimes combine the approach between shares and asset deal together to achieve the separation from business aspect and in tax efficient manner, depending on the deal strategies. Next slide, please. In this slide, I'd like to briefly touch on the key tax consideration of the share deals in Thailand. Unlike certain countries, change of the ownership would not impact the ability to utilize accumulated tax losses of the Thai target. Capital gain, if any, is subject to tax law of the seller jurisdiction, or in this slide, holdco jurisdiction. Talking about withholding tax, basically 15% Thai withholding tax would apply on the capital gain payments from Thailand, with the possibility to relieve under certain tax treaty, and shall be assessed on a case-by-case basis. This is scenario 1 of the slide. For scenario 2, as the parties are overseas entities, there is currently no mechanism under Thai tax law to tax the capital gain from the transfer of shares in a Thai company between two non-resident parties having no taxable presence in Thailand. And in the third scenario, the indirect share transfer, no Thai tax implication to consider for the time being. From stamp duty perspective, 0.1% is technically payable by the seller. However, if the document is executed overseas, the first holder of the original share transfer document is the party liable to Thai stamp duty. Next slide, please. In this slide, we'll be discussing on the asset deal or business transfer. Selective business could be carved out to the buyer, and the seller may remain active or being required to be dissolved, depending on the carve-out scheme. Starting with scenario 1, the business transfer. Key tax implications are 20% corporate income tax on gain, and also include indirect taxes, which are 7% value-added tax, 3.3% specific business tax, and 2% transfer fee in case of real estate transfer. Step-up cost base for tax depreciation or amortization is allowed. Tax losses, if any, would remain with the transferor, and no dissolution of the transferor is required. However, a qualified partial business transfer or PBT is entitled to indirect tax exemption, provided that the PBT is done between related companies and meeting other requirements and conditions. Turning to second scenario, the entire business transfer or the EBT. The EBT is entitled to most Thai tax exemptions. Key conditions are all asset and liability must be transferred at the market value, and the transferor shall be dissolved and liquidated in the same accounting period of the EBT. Tax losses, if any, would remain with the transferor, and step-up cost base for tax depreciation is not allowed under the EBT scheme. If all requirements are met, any gain or loss realized from the EBT shall not be treated as revenue or expense for corporate income tax computation. indirect taxes would be exempt as well. However, 2% transfer fee on real estate transfer would not be exempt, and gain from the investment, if any, at the level of the shareholder from the dissolution is taxable unless share swap is implemented. As a precaution of the EBT, I'd like to highlight that if any items of the asset or liability remains outstanding after the EBT, there is a risk that the Thai Revenue Department would deny the applicability of the EBT exemption on the basis that not all assets and liabilities are transferred. Moving to the last scenario, the amalgamation. Amalgamation is entitled to full tax exemption if comply with the conditions and notification requirements, but pre-existing tax losses in the amalgamated company will be gone. One of the potential obstacles of amalgamation is legal procedure, which is time-consuming and should be well prepared. Apart from tax consideration of the carve-out, there are regulatory considerations, especially whether the acquiring entity has a proper license to operate the acquired business. In certain cases, the process to transfer or newly apply the license may impact the continuity of operation from commercial aspect until obtaining the license from the government authority. So if the carve-out is to be considered, it will be key to consult your tax and legal advisor to understand the conditions, the procedure, and the timeline for each approach in order to identify the most appropriate view strategy. That's pretty much I want to cover from Thailand, and I will now hand it over to Nan to talk about Vietnam. Nan, over to you.
Thanks, Neil. For Vietnam, similar to the other country, it's observed that the typical approach for carve-out plan would include first, the share transfer, where the parent company can decide to transfer a portion or the total share is holding in a Vietnamese subsidiary directly or indirectly via certain offshore SPV. The carve-out can also be done by the asset transfer, where the Vietnamese subsidiary will transfer a part or all of its assets in Vietnam to a potential buyer and proceed to liquidate the company after that. We also have the merger, which allows a large company to split off one or more divisions to operate independently. And as a result of this demerger, there will be a existing company and a newly set up company, and each of them after the demerger will manage the operation of a specific business activity of the group. Moving on to the next slide. To be more specific into each of the carve-out option, let us start with the most common approach of share transfer. So under a direct way, the investor will transfer the share they're holding directly in a Vietnamese subsidiary. And in this case, the implication to the seller would be different. Specifically, the corporate seller will be subject to corporate income tax at the rate of 20% on its taxable gain if the Vietnamese subsidiary is a private company, while the tax payable in this case would be 0.1% on the cross-sale process if the Vietnamese subsidiary is a public company and the share being transferred are considered as security under the law on security. Tax relief under the treaty between Vietnam and the other country where the seller is a resident could technically be sought to apply. However, we would like to highlight that in recent years, the Vietnamese tax authority become really aggressive in interpreting the provision of the tax treaty, as well as scrutinizing the treaty application dossier. And apart from the treaty provision, the local tax authority also based on a domestic circular that provide guidance on implementation of the DTA between Vietnam and the other country to assess the possibility of applying the tax exemption or reduction in Vietnam. And it's worth noting that under that local regulation, in order for a DTA applicant to apply for tax relief, that applicant have to pass the 7 beneficial ownership tests. And the most challenging test is that the DTA applicant must participate in essential business activities such as production, trading, or service provision, and must have sufficient capability to generate the income. And because there is no other further guidance on what would be considered as essential business or sufficient capability, whether a DTA applicant is qualified for tax exemption or reduction in Vietnam only be assessed on a case-by-case basis. And other than the capital gain tax or the withholding tax in case of security transfer, there will be no other transfer tax, value-added tax, or stamp duty they impose on a share transfer. And also, no tax clearance is required to be conducted for a share deal. For the case of indirect share transfer, so in the past, the indirect structure was widely adopted because the foreign investor, they believe that there would be no Vietnamese tax implication upon the divestment from Vietnam by transferring all of the share they're holding in an offshore SPV to another investor. However, in recent years, we noted that the situation has been changed quite significantly because now the Vietnamese tax authority, they believe that the indirect offshore share transfer would be subject to tax in Vietnam in a similar manner as a direct transfer. Therefore, taxable gain earned by a foreign corporate shareholder in this case would potentially be subject to corporate income tax at the rate of 20%. And accordingly, there's no longer a tax-free divestment from Vietnam by relying on this indirect share transfer structure. For asset transfer, technically, corporate income tax at the rate of 20% would be applied on the gain. And in addition to that, VAT at the rate of 0%, 5%, or 10% could also be applied depending on the assets being transferred. Stamp duty could also be imposed upon transferring the ownership of certain assets, for example, the land or the vehicle. But this stamp duty should be borne by the purchaser rather than the seller. And please also be mindful in this case that the seller might also be subject to import duty clawback in case the assets being transferred are the ones that were entitled to the import duty exemption in the past. And more importantly, if the investor wants to discontinue its operation in Vietnam, the Vietnam company had to proceed with the liquidation, including the tax clearance, which should be expected to be time and effort consuming. Next slide, please. Last but not least, here we have the merger, where the parent company can decide which business it would like to split up for operating independently or being sold off. And based on the local regulation, in case the merger is proceeded without any revaluation of the assets being demerged, there should not be any Vietnamese tax implication, including corporate income tax, value-added tax, or stamp duty. And no invoice is required to be issued upon handing over the asset to the newly set up company as a result of the demerger. And in terms of administration procedure, it is required under the regulation that the existing company, upon the merger, had to cut off its accounting record and have its financial statement audited and conduct its tax finalization within 45 days since the merger decision day. And at a later stage, when the parent company, they would like to divest from either the old company or the newly set up company, then they can proceed with the share transfer approach. And the relevant tax implication in this case would be similar to those that we have discussed just now. Yeah, that's all for Vietnam. Back to you, Daniel.
Thanks, Nan. So we kind of reached the end of the formal presentation. I'll just do a quick closing. So I guess just to highlight that basically, as you have gone through earlier, carve-out mechanisms can vary significantly in different Southeast Asian countries and can have different tax implications. For example, we have learned about the spin-off in Indonesia and the demerger concept in Vietnam. And usually, in a carve-out situation, the buyer would expect the seller to execute a pre-sale restructuring to carve out the target business, and this is usually done post-signing, but obviously before completion. And in terms of taxes, any taxes that arises from the carve-out, such as transaction taxes, is typically borne by the seller. And the last point I wanted to highlight is that all this will need to be considered in terms of if you are considering a carve-out, you need to take into account upcoming changes in the international tax rules, in particular OECD Pillar 2 rules, where, as most of you might be aware, the Pillar 2 rules would introduce a 15% global minimum tax for in-scope M&Es, which basically covers multinational groups with 750 million euros of consolidated revenues, such that if the effective tax rate in any particular jurisdiction falls below 15%, then the top-up tax needs to be paid. And interestingly, based on the Pillar 2 rules, at least based on what we read, when there's a demerger, the revenue threshold for each demerged group is considered separately before in terms of determining whether each group falls under the scope of Pillar 2, which is the 750 million euros revenue threshold. And also, just to highlight, if there's any gain on sale of shares, equity shares, which are not portfolio shares, that is not included in what we call the group income, meaning that for the purpose of computing the ETR. So meaning that any such gain is excluded from the income in arriving at the ETR. But on the other hand, when there's a sale of assets, any gain is generally included in the group income, unless exception applies. So what this means is that, if the gain on sale of assets is not taxable, but the gain is included in the group income, then your ETR might be reduced, and you might end up having to pay a top-up tax depending on whether your ETR drops to less than 15%. So we've come to the end of the presentation today. I think we have some time for Q&A, and I see many questions today, and I probably just picked two or three questions. And maybe the first question I will ask is for Kwang Gaek. There is a question around what are the Malaysia tax implications for buyer in terms of financing costs. Kwang Gaek, any comments on that?
Right. Thanks, Daniel. Financing costs, right? So I'm assuming that there's going to be a setup of a company in Malaysia to acquire the shares or the business of a company in Malaysia. So if the Malaysia company borrows to acquire the shares of the target company in Malaysia, then the interest expense that you incur will not be deductible. Why? Because the dividend that is coming back to you, the dividend income is exempt from Malaysian tax. So if it's exempt, then likewise the expense relating to that income will not be deductible. Now, if the Malaysian company then you are thinking about acquiring of the business of the target, you borrow to acquire the business of the target, then the interest expense should be tax deductible since the loan is used to acquire assets which will generate the business income for the Malaysian company. Now, on top of that, there are some conditions here you need to remember before a tax deduction can be claimed for interest expense. One, the interest expense must be due. Number two is that if the loan is obtained from a non-resident, then you need to ensure that withholding tax on the interest payment is deducted and remitted to the Malaysian tax authorities. And the third condition there is that if it's a related party loan, then you have to observe the arm's length, that the interest rate is arm's length. That's it, Daniel.
Thanks, Kwang Gaek. I think we have time for one more question. I'll just pick a question relating to Thailand. This question is for Nyon. We understand that in Thailand, there are tax incentives offered by the Thai Board of Investment for certain business sectors. Would those incentives be transferred along with a business carve-out?
Yeah, thank you, Daniel. Basically, yes. And the transferee would enjoy the remaining tax incentives being transferred. However, please take into account that the incentive would not automatically be transferred. The parties may need to obtain a pre-approval from the government authority prior to undertake the carve-out. Otherwise, there might be an argument on the breach of certain conditions, giving rise to an inability to enjoy or withdrawal of the incentive at the level of the transferee. Daniel.
Thanks, Nyon. I think we have just reached 3 p.m. and unfortunately, that's all the time we have for today. We have quite a number of questions and we'll try to address it after this session separately. But I just wanted to thank all the speakers here today. Thank you, Suan, John, Nan, Kwang Geok, and Nyong. Thanks for participating in the session today. And to the audience as well. Thanks for all of you who were able to join us. We would like to encourage you to fill in a short survey that will pop up on your screen and tell us what you think about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others will benefit from this webcast, please share the webcast via the share this icon or have them visit our debriefs website. We'll respond to all your questions that you have raised today in a couple of weeks. And if you have any other questions or comments later, please feel free to reach out to either myself or the speakers. We'll be more than happy to speak to you. And lastly, from all of us at Deloitte, thank you for your participation and have a good day. Thank you. Goodbye.